what we're going to do now is we're going to introduce the rest of the panelists, and then we'll have them do their presentations, and we'll then take questions. Dr. Nora Lustig is a native of Argentina. Currently, she resides in Mexico and works with the Colegio de Mexico. She is currently a JB and Maurice C. Shapiro Visiting Professor at George Washington Elliot School for International Affairs. Prior to this, she served as president of Universidad de las Américas Puebla in Mexico. Before her post was as president of the university, Dr. Lustig was chief of Poverty and Inequality Unit at the Inter-American Development Bank. Dr. Lustig has also been a senior fellow at the Brookings Institution and a professor of economics at el Colegio de Mexico. Dr. Paolo Sotero. Mr. Sotero is currently the director of the Woodrow Wilson Center's Brazil Institute. For the last 17 years, Mr. Sotero was a Washington correspondent for Estado de Sao Paulo. As leading Brazilian daily newspaper, he has also been a regular commentator and analyst for the BBC radio. Sorry? I'm sorry. Yeah, okay. So, well, but we're just introducing all of them. So he's been a regular commentator for the BBC Portuguese Language Service, Radio France International, and Radio El Dorado in Brazil. Since 2003, he has been an adjunct lecturer at Georgetown University, both the Department of Spanish and Portuguese in the Center for Latin American Studies of the Edmund A. Walsh School of Foreign Service. And finally, we have Mr. Carlos de Abreu. Mr. Abreu is currently Brazilian Embassy's Deputy Chief Mission and Minister Counselor for Economic Affairs, a Brazilian career diplomat. Minister Counselor Abreu has served as head of the Market Access Division at the Ministry of Foreign Relations and as advisor to the Minister of France and as advisor to the Undersecretary for Policy Planning at the Ministry of Foreign Relations. His diplomatic postings also include the Brazilian Embassy in Bolivia, Argentina, and the Consulate General in San Francisco. And we're going to begin. Mr. Sotero, is it? Who's the first presentation? Okay, Dr. Lustig. Okay.
Now, let me move to the. I have a PowerPoint presentation. I don't know if just to. Okay. Let's see this. Well, thank you very much for the invitation to NDN. Thank you, Joe, for the kind introduction, and also I'm delighted to be here with my co-panelists and to have an opportunity to share with you what kind of a mess we're in. And I don't know how to get out of it, but we'll discuss some of the implications that the mess has for Latin America. So how, this is, what do I hit? Because this is.
Should start there.
All right, so you know who I am. Okay, I think that you mentioned at the beginning, Joe, that we were in a world that we thought whatever happened in the U.S. was going to be more or less self-contained within the U.S., and that that actually led to a number of things that I think when people will study this period will really try to understand why there was this sort of misleading perception of how things were going to evolve, because the policy responses actually made it worse for what happened afterwards. Because when if you go back to mid-2007, that's when the subprime crisis expressed itself through the failure of one of the Bear Stearns funds. Up to mid-2008, the expectations were that there was going to be a mild recession in the advanced countries, that there was going to be decoupling, that China was going to be the engine of growth for the rest of the world, and that the US monetary policy would lead to a weakening of the dollar because interest rates started to fall, there was going to be monetary expansion, the dollar would depreciate. And as a result, what happened in this period is that capital started to move very quickly into emerging market stocks, into bonds also, and emerging markets, foreign currencies, and commodities. And everything went up at the same time. And it went up at a time, particularly for commodities, it was peculiar because even if you had decoupling, global growth was going to slow down as a result of a slowdown in the US. And it is precisely at that time when the prices of commodities began to accelerate very sharply. So it's kind of defied what economists were expecting. And the dollar depreciated. So you had sort of mirror image of these two. The biggest fears then were inflationary pressures. So some governments began to implement policies to actually protect themselves from these inflationary pressures. Some policies were more of the mainstream kind, like raising interest rates, trying to contain fiscal accounts, and also the non-orthodox types like export taxes or export restrictions, a number of things that people were trying to do to avoid the pass-through of the particularly food and fuel inflation into domestic inflation. Some areas also did not refuse to ease. That was the case of the European Central Bank, which for a long time kept interest rates steady. And at that time, the other thing which was not a fear but a reality was the adverse external shock for oil and food importing economies in a region which affected primarily Central America and the Caribbean that were getting hit very hard by that, and also by the slowdown in the US because that meant lower exports, lower remittances, lower tourism. Okay, then the realization was that the financial system in advanced countries was actually facing solvency problems much deeper than people anticipated. I think that was one of the things that happened that changed the expectations. That what was supposed to be a mild recession was not, and that the advanced economies were actually facing quite a severe, deep economic recession. We didn't know, 3-4 months ago how deep, but that was when expectations began to change. Emerging economies would face a growth slowdown. There was no decoupling, as some of the data that began to come from particularly China, India, and other places. And in addition to that, the post-Lehman collapse, which led to a global credit market freeze, made everything worse. As a result, you had the massive redemptions of capital, you had a flight to quality, the demand for dollar and US Treasuries skyrocketed, and all the prices, except the dollar, fall. You had exactly the opposite trend. The dollar begins to appreciate very fast, and commodity prices plummet, stocks and bonds in foreign countries plummet, and so do foreign currencies. That's when the euro begins also to fall very sharply. And so what happens, what are the biggest fears sort of globally are that there may be a deep unprotected global recession. I think people accept that we are in a deep and longer probably recession, but we don't know how much longer this recession will be. There's fear of deflation in many parts of the world. And for the Latin American region, I think the adverse external shocks are now the opposite. It's for the commodity exporters, which are facing terms of trade shock because all these commodity prices are falling simultaneously. And, but also for the economies that are relying on exports to the US, remittances, tourism, and external capital flows, even if they get a relief from the falling commodity prices, that is not enough to compensate for this phenomenon. So here, this I think allows me to show you, what's happening with oil, how oil started to sort of go up very quickly in this phase one, which is the one that was from mid-2007 to mid-2008, and how then things begin to fall. If we extend this graph, we would continue to fall. The same thing happened with food commodities, that you had this incredible acceleration in the post-mid-2007 period. And capital inflows to the region, which were rising very quickly for quite a while. During phase one, they sort of continue to rise, but in phase 2, they begin to fall. Because now, like I said, there's this flight to quality, and this very sharp increase for treasuries and demand for dollars throughout has created some forms of capital outflows. So what are the expectations now in terms of what kind of world are we living in? And to look at what happens and what kind of world we're living in, it's usually, you need to change this more or less every week. This is October 24. For example, well, this is a forecast from JP Morgan. But, well, JP Morgan, I think that has still China with 8% from a conference call that I heard this morning. But the World Bank already has put the growth for China at 7.5. So, and every time you read any forecast, they become lower and lower. But that's, what the world looks now as of the end of October, which means that 2009 is going to look very ugly because you have negative growth in the most powerful economies in the world. So that doesn't mean anything good for the rest, of course. Even if they were doing relatively better than these economies, they were not. I mean, for China, even growing at 7.5 is pretty disastrous because they were growing at 11 and 12%, and that creates tremendous pressures on unemployment. So what are we going to? How do we think about Latin America and the impact of the crisis? I think that well, any time that we want to see what might be the effect of the crisis on Latin America, we look at the financial channels and the channels through the real economy. And the financial channels, for a while, were considered to be pretty secure, if you want. There were not going to be problems in the financial sectors in Latin America because the banking sector had already gone through crisis, and therefore they had learned the lessons, and also because the foreign banks were making money without having to invest in risky assets, and so that was very reassuring. However, when you had the Lehman collapse and all its sort of impact that it had on financial, on credit markets throughout the world, and which was immediately followed by this flight to quality, what happened is that we discovered that in two of the largest economies in Latin America, the corporations had made bets for sort of the wrong bets, because they assumed that their currencies would continue to appreciate. So when they faced the depreciation, they were stuck with very serious problems, and some of them had to even go bankrupt, particularly in Mexico. But also there were many companies like in that situation in Brazil. So there was a new thing. In addition, because these companies in Mexico and Brazil were international companies, they had debt that's dollar debt, and they had to face then servicing this debt at a more depreciated local currency, which put quite a bit of pressure on them. And there's quite a few companies that are like that. This was really very scary at the beginning of October, mid-October. Now it seems it's been, they found ways in which they can shore it up with the development banks, the domestic development banks, and they have created, mini rescue activities for all these companies that were in dire straits in both countries. So it doesn't seem to be as dire as it was a few weeks ago. Then you have the reduced access to international credit markets, which it is affecting the economy, which means that coupled with capital outflows, that to actually be able to fund themselves, particularly again the private sector, because in many of the countries the public sector is fine, but it will still have to roll over its debt. But it will be more expensive to have access to these resources. So there is pressure on the financial side, different from one that we anticipated. And every time there's a crisis, I always say, where are we going to discover something that we hadn't thought about? And what we hadn't thought about was this, this investments in risky assets. Then on the side of the real economy, I mean, obviously exports are falling, remittances are falling, and the growth in tourism also is, well, they're not falling. Everything is growing at a lower rate. I should say. And the lower commodity prices are bad news for Mexico and South America, and like I said, they're good news for the rest, except that they're insufficient good news to offset the bad news that comes from this part. So what are the prospects? It would have been perhaps interesting to have Luis Alberto here, but last week they had this group of former central bankers and ministers of finance that are part of the shadow committee on financial regulation that is housed by the Center for Global Development from Latin America, and they issued a statement in which is out, I think it was published by the Financial Times, but it's also on the website of the Center for Global Development, where they estimate that next year the region will need something to the tune of $250 billion to roll their debt and budget support. So this is public sector requirement, and they don't think that that's going to be available easily for the region, and that what's out there on the part of the multilaterals is not going to be enough. So they're proposing to create a sort of special facility that would channel resources using also the multilaterals, but it will require much more in terms of resources to be able to cope with these needs. Then in terms of growth, right now I think the predictions are converging that Latin America will grow at around 0.9% in 2009 with downside risk, and that this is three percentage points lower than what it was growing in this past, and also its potential. There is the view that Argentina and Mexico are probably in a recession or might face a recession, and that Brazil is a borderline country. Maybe we'll hear more about that from our two speakers. And undoubtedly, poverty and unemployment will rise in many of the countries, and unclear what will happen to inequality, because people that are at the top are also getting hurt. So here, you have some of what happened to growth in the region, and this is the estimates that J.P. Morgan had in October, and it's already lowered it to 0.9% within 2-3 weeks. So at least the forecasting is moving fast. So our country is ready to cope with this. For example, we always ask, okay, you have the needs that occur at the macroeconomic level, but also you have the needs that maybe you can try to help the poorest parts of your population. Even if you face a slowdown, are you going to be able to deal with this in some way? And as you know, one of the instruments that are being used a lot in Latin America are the cash transfers, in particular the conditional cash transfers. And the IDB put together an analysis how many countries do have these at a sufficient scale that would be able to be used to help cushion the impact on the poor. So there's 8 out of these 26 that are here. We're fortunate that 2 of the largest countries that have the largest, the largest number of the poor in Latin America, when you add them up, are combining Mexico and Brazil. You have a good chunk of them. So it's good that these 2 countries have the largest and most institutionalized programs to deal with this. But you have many of the poorest countries that don't have anything, like Haiti, Nicaragua, places like that. So of course, in these countries, like in Haiti, you probably need a cash transfer for the entire population, given that the income per capita is so low. Bolivia also doesn't have one. So I think that we do have a problem that countries are not ready. In addition, there's very few that have anything in the way of employment programs, since probably what we're going to see is an increase in unemployment or deterioration in the quality of employment, a lot of underemployment as a result of the crisis. There is really not preparedness in the region to deal with that, which is bad news. Finally, I wanted to say a few things about Mexico, because somebody asked me to talk about Mexico, and I guess what I want to say is, really, this time Mexico had nothing to do with what's happening to itself, for once, like they say every time. They were following very too prudent domestic macroeconomic policies. They have a balanced budget law, which I don't understand how it was passed. but it's there. They followed very, very sort of conservative monetary policy. The banking sector was not exposed to the subprime, but they've been very severely hit by the external shocks, the fall in oil prices, and the U.S. recession. Of course, Mexico exports more than 80% of its exports come to the U.S. And then, we had these vulnerable spots in the corporate sector, which I referred to earlier. So, Mexico faced this decline in oil prices. Here you have the mezcla mexicana, which falls, but it's much lower, the price also. Fortunately, I think that the government hedged itself against future falls for a while, so that it's not going to be so terrible. Here you see, whenever the U.S., whatever happens to the U.S., which is in blue, except when the tequila crisis happened, that was homemade. But in the rest of the cases, you have a very sort of high correlation between what happens to the U.S. business cycle and how it affects Mexico. So Mexico is going to get hard hit by what happens in the U.S. And here you can see the growth, and here's what the forecasts that are. The government is still forecasting more than 1% growth for next year, but most of the private sector forecasts have much lower estimates. And so, this is one of the analysts in Mexico that has its own forecasting project, and that if the U.S. falls by minus 0.6, which is now more or less a consensus, then Mexico's growth will be around 3%, meaning that part of the year, next year, will have negative growth. So Mexico will probably face a recession, and this time completely external, not homemade. They have introduced a package to respond to this, but it has to be very modest because the countries don't really have that much room to maneuver to actually expand their fiscal account. I mean, the U.S. has the luxury, and some others like China, to introduce counter-cyclical policy to deal with the crisis. But countries that are still do not enjoy the same amount of credibility, or have less, if you want, fiscal largesse or less reserves, then they can't. But Mexico has introduced a small fiscal stimulus, and even with the stimulus, this forecast includes the stimulus, the 0.3%. It's still going to be, if everything goes well, stagnant, if not worse. So that's a story about Mexico. And finally, I wanted just to say a few things about the U.S. role. I think, it was very important what happened. I don't know how people didn't put that much attention in the press. I guess so much is happening at the same time that it's hard to focus on this. But the announcement of the Federal Reserve in October to have these swap arrangements with 4 countries that were in the emerging markets, including Mexico and Brazil, Singapore and Korea, was very important to decrease the pressures that were being put on the currencies in Brazil and Mexico. Even if the swaps weren't used, there was a signal that the Fed was going to be there to back these countries. And I think that as a signaling worked very well. So these this was a very good decision, although there's a bit of a discussion whether it's good to have the Fed do this if you have the IMF on the same day announcing the special facility. Apparently, I don't know how much coordination there was there, but obviously if the Fed is going to provide funds, people will prefer to go to the Fed than to the IMF. So at some point, there's going to have to be a decision of how these sort of cushioning devices will be orchestrated in a way so that you don't create a pecking order of countries that may not be what you want initially. I think that also maybe the US will, if the idea of this facility takes place, the facility that was recommended by this Shadow Committee on Financial Regulation, then I think it would be an opportunity for the US to try to sort of bolster the amount of resources. Part of it can be through the swap arrangements as part of this. I think that also it's very important, as Luis Alberto Moreno mentioned, that they avoid any sort of, which is going to be hard, I think, but any attempts to introduce protectionist measures, which may not come out as, you know, overt increases in tariffs, but I think we might see a lot of contingent protectionism. And that's going to be something that obviously is going to hurt the trading partners, and particularly Mexico and Central America. And I think it would be good to send the signal that there'll be continuation of support for trade agreements. And finally, I'm going to leave this as a question mark because I never know how to, you know, deal with this. It is a very serious problem for countries, particularly Mexico and Central America, the fact that now, you know, there's going to be the safety valve is not going to be there. So this was a safety valve. In the past, when Mexico faced crisis, a lot of people could move to the US and find jobs here. Now that's not going to be there. And it's not going to be there because there's not going to be jobs here. And also, I think there's going to be quite an increasing resistance in making migration, in any kind of agreement to make migration more sort of legitimate and allow flows to increase. But this is something that's going to have to be dealt with because particularly with respect to Mexico, I think we do have pretty much of a time bomb next door but I don't have time to get into that, but Mexico is a country that, as you know, is going through many, many difficulties, and if you have lots of young people returning without jobs to places in the border or nearby, I don't think that we can expect many good things happening from that. Anyway, that's all I wanted to share with you, and look forward to your comments.